Hi, welcome back. If you have been watching the gold and silver charts over the past week, you already know something unusual is happening. Gold has pushed back above the $4,100 level, silver has been climbing right alongside it, and both moves are happening just days before one of the most closely watched Federal Reserve decisions of the year. If you are someone who owns physical metal, holds a mining stock, or is simply trying to understand where your savings might be safest heading into the back half of 2026, this is exactly the kind of week you want to pay attention to. So let's break this down together, calmly and clearly, without any hype, and figure out what is actually driving this move and what might happen next. To understand why this week matters so much, you have to rewind just a little. Earlier this year, gold touched an all-time high near $5,500, and silver spiked to levels above $120 an ounce. Then came a sharp correction. Inflation numbers came in hotter than expected, oil prices jumped because of renewed tension in the Middle East, and traders began pricing in the possibility that the Federal Reserve, now led by Chair Kevin Warsh, might actually raise rates instead of cutting them. That combination hit precious metals hard. Gold fell more than a quarter from its peak, and silver dropped by roughly half. For a lot of everyday investors watching their portfolios, that was a nervous stretch. But here is what this means for where we stand today. Prices did not keep falling forever. Instead, they found a floor, stabilized, and over the past couple of weeks have started climbing back. Gold has moved from the high 3,000s back above 4,100, and silver has pushed up into the high 50s and even briefly touched the $60 mark. Now this is important because this recovery is not happening randomly. It is tied directly to shifting expectations about what the Federal Reserve will do at its meeting on July 28th and 29th. Think about it this way. Gold and silver do not pay you interest the way a bond or a savings account does. So when interest rates are high, or expected to go higher, holding metal becomes less attractive compared to holding cash or bonds that pay a return. That is why fears of a rate hike pushed prices down earlier this summer. But recently, several pieces of economic data have come in a little softer than expected, including a cooler than forecast inflation reading and signs that the labor market, while still solid, is not overheating the way it was a few months ago. That has led many traders to believe the Fed is more likely to hold rates steady this month rather than raise them again. And when the odds of a rate hike go down, gold and silver tend to go up because the opportunity cost of holding them goes down too. There is also a broader story happening underneath all of this, one that goes beyond just this single Fed meeting. Central banks around the world, including China's, have continued buying gold nearly every single month this year, extending a streak that now stretches back close to 2 years. When a central bank buys gold, it is usually doing so for long-term reasons, things like diversifying away from any single currency or building a buffer against future uncertainty. That kind of steady, patient buying does not show up as a dramatic headline, but it acts like a quiet floor underneath the price, even during the weeks when short-term traders are nervous. Silver's story right now is a little different from gold's, and it is worth understanding why. Silver is what is sometimes called a dual-demand metal. Part of its price is driven by the same investment and safe haven forces that move gold, things like interest rate expectations, currency strength, and geopolitical uncertainty. But the other part of silver's price is driven by something gold does not really have, and that is heavy industrial demand. Silver is used in solar panels, in electronics, in electric vehicles, and increasingly in the data centers and chips that power artificial intelligence systems. The Silver Institute has estimated that global industrial demand for silver will stay above 700 million ounces again this year. That is a massive amount of metal being consumed by factories and manufacturers, not just sitting in vaults as an investment. Here's what this means in practice. When investment demand for silver rises at the same time, industrial demand stays strong. You can get sharper, faster price moves than you typically see in gold. That is part of why, on the days when precious metals rally, silver often moves by a larger percentage than gold does. Some analysts describe this using something called the gold-to-silver ratio, which simply measures how many ounces of silver it takes to buy 1 ounce of gold. When that ratio is unusually high, some investors see it as a signal that silver may be undervalued relative to gold, though it is worth remembering that ratios like this are just one tool among many, not a guaranteed predictor of what happens next. Now, before we go further, if you are finding this breakdown useful, take a second to hit that like button and subscribe to the channel. It genuinely helps more people find these explanations, and I put a lot of care into making sure every video here is accurate, balanced, and actually useful for your understanding of these markets. All right, let's keep going. So what exactly happens on the day of the Fed's announcement, and why does the market react so quickly? When the Federal Reserve releases its decision, usually in the afternoon, traders are not just listening to whether rates were held or changed. They are listening closely to the language the Fed uses to describe inflation, the labor market, and its outlook for the rest of the year. A statement that sounds cautious about future rate hikes can send gold and silver climbing within minutes, while a statement that sounds more hawkish, meaning more open to raising rates later, can cause a quick pullback. This is part of why you often see precious metals prices swing sharply in the hours immediately following a Fed announcement, even before the broader implications are fully understood. It is also worth remembering that the Fed meeting itself is not the only date that matters this month. Just one day after the rate decision, another major economic report is scheduled for release, the Personal Consumption Expenditures Price Index, which is actually the Fed's preferred measure of inflation. Think about it this way: the rate decision tells you what the Fed has already decided based on the data it had going in. But a report like this can shift expectations for the next meeting almost immediately. So even after the initial reaction to the Fed's announcement settles down, this next inflation reading could end up being just as influential for where gold and silver head over the following days. It also helps to put this year in some historical context, because 2026 has genuinely been an unusual year for precious metals. Gold's move to an all-time high above $5,000 earlier in the year, followed by a correction of more than a quarter, followed now by this recovery back above 4,100, is the kind of volatility that even long-time market watchers describe as significant. Silver's swing has been even more dramatic, moving from over $120 down to below $60, and now clawing part of that back. For comparison, gold has gone through similar boom and correction cycles before, in the early 2010s and again in the early 2020s, and each time the pattern looked broadly similar: a period of rapid gains driven by uncertainty, followed by a sharp pullback once that uncertainty eased or interest rate expectations shifted, followed eventually by a new equilibrium. That does not guarantee history repeats itself in exactly the same way, but it does offer a useful reminder that sharp moves in either direction are not unusual for this asset class, and reacting to any single week in isolation can be misleading. Let's talk about the physical side of this market too, because it is something that often gets overlooked. A meaningful portion of gold and silver trading happens through paper contracts, meaning futures and other financial instruments that represent metal without anyone actually moving bars or coins. But there is also a physical market, where real metal changes hands, gets stored in vaults, and gets delivered to buyers who want to hold the actual asset. When physical demand from investor jewelers and industrial buyers is strong at the same time, paper market positioning is heavy. It can create extra pressure on prices, particularly in silver, where the available above-ground supply relative to demand is considerably tighter than gold's. Now, it is important to be balanced here and acknowledge the other side of this story too. Precious metals do not move in a straight line, and there are real risks and uncertainties worth keeping in mind. If inflation data comes in hotter than expected in the weeks ahead, or if the Fed signals a more aggressive path toward higher rates, gold and silver could give back some of these recent gains fairly quickly. Geopolitical tensions, like the ongoing situation in the Middle East, can also cut both ways. Sometimes they push investors towards safe haven assets like gold, and other times, when they drive oil prices higher and stoke inflation fears, they can actually increase the odds of tighter monetary policy, which works against metals in the short term. This is a market shaped by multiple forces pulling in different directions at once, not a simple one-way story. There is one more piece of the puzzle worth understanding, and that is the relationship between gold, silver, and the US dollar. Precious metals are priced in dollars around the world, so when the dollar weakens against other major currencies, gold and silver often become cheaper for buyers overseas, which can boost demand and push prices higher. When the dollar strengthens, the opposite tends to happen. Over the past several weeks, the dollar has pulled back from some of its recent highs, partly because traders are pricing in a less aggressive Fed, and that softening has been another quiet tailwind for metals, Real yields matter too, meaning bond returns after accounting for inflation. When real yields fall, gold and silver tend to look more attractive by comparison. The dollar, real yields, and rate expectations tend to move together, which is why a single Fed meeting can ripple through so many parts of this market at once. A simple way to think about all of this moving forward is to picture three layers working together. The first layer is monetary policy, meaning what the Federal Reserve is doing with interest rates, and how that affects the appeal of holding non-yielding assets like gold and silver. The second layer is structural demand, meaning the steady, longer-term buying from central banks and from industries that rely on silver for manufacturing. And the third layer is sentiment and momentum, meaning how traders and everyday investors are feeling about risk, inflation, and the broader economy on any given week. When all three layers point in the same direction, like they seem to be doing right now, you tend to get the kind of sharp move we have seen over the past couple of weeks. When they conflict with each other, prices tend to move sideways or become more choppy and unpredictable. So what does this actually mean for someone watching this video, managing their own savings or portfolio, and trying to make sense of the headlines? It does not mean you need to make any dramatic decisions based on a single week of price action. What it does mean is that this is a good moment to understand the mechanics behind why prices move the way they do, so that when you see gold and silver headlines in the future, you are not just reacting to a number, you understand the forces underneath it. Precious metals have historically played a role for some investors as a way to diversify a portfolio and to hedge against inflation and currency uncertainty. But like any asset, they carry their own risks, including price swings that can be sharp in both directions. Anyone considering how metals fit into their own financial picture should think carefully about their own goals, their time horizon, and ideally, talk with a qualified financial professional who understands their full situation. Looking ahead, there are a few realistic paths this could take. If the Fed holds rates steady and signals a more patient wait-and-see approach for the rest of the year, gold and silver could continue building on this recent strength, especially if central bank buying and industrial demand for silver remains steady. If inflation data surprises to the upside or the Fed sounds more concerned about rising prices, we could see a cooling-off period where gold and silver pull back and consolidate before their next move. And if geopolitical tensions escalate further, that could add another layer of volatility that is harder to predict with any precision. None of these outcomes are guaranteed, and anyone telling you they know exactly what happens next is overstating their certainty. What we can do is understand the framework, watch the actual data as it comes in, and make informed decisions rather than emotional ones. To bring this all together, gold pushing back above $4,100 and silver climbing toward the $60 range is not happening in a vacuum. It reflects softer inflation expectations, growing belief that the Federal Reserve will hold rates steady this month, continued central bank gold buying around the world, and strong industrial demand underpinning silver in particular. The Fed's decision at the end of this month, along with the inflation data that follows right behind it, will likely set the tone for precious metals through the rest of the summer. Whatever happens, understanding these layers, monetary policy, structural demand, and market sentiment gives you a much clearer lens for interpreting the headlines than just watching the price bounce up and down on a chart. That's it for today's breakdown. I hope this helped you understand not just what is happening with gold and silver this week, but why it is happening and what to watch for as the Fed decision approaches. If you found this valuable, please consider subscribing so you don't miss the next update, and drop a comment letting me know what part of the precious metals market you would like explained next. Thank you so much for watching. Take care of yourself and your finances, and I will see you in the next one.